Welcome to Stress-Free Investing Analysis Personal Notes. Today, we're tearing into Fine Organic Industries Limited, or FINEORG. It's a genuinely fascinating story right now. We've got a company going through some serious short-term pain, but underneath all that, they might just be setting up a massive long-term opportunity. So we're going to tune out the quarterly noise and dig right into their fundamentals to see what's really going on with this specialty chemicals giant.
Now please take a quick look at the SEBI disclaimer on your screen. Just a reminder, I'm not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks, and the data and charts we're looking at are based on public info and my own personal research notes. Don't treat this as a buy or sell recommendation, okay? Always do your own due diligence or chat with a SEBI-registered pro before making any moves. All right, let's get to it. So here's our agenda. We've got 6 key areas to cover today. 1. The Fine Organics Moat. 2. Financials, peak versus normal. 3. The current margin squeeze. 4. The mega expansion master plan. 5. Valuation and scenarios. And finally, 6. Verdict and key monitorables. Let's jump in.
Section 1. The Fine Organics Moat. Okay, so look at this revenue breakdown. You've got polymer additives taking up roughly 45% of their business, followed by food additives at 35%. But here is the real kicker about that 45% chunk. Fine Organics holds a near monopoly in the domestic polymer additive market. We're talking a 70 to 80% market share. They are the absolute undisputed leader here in India. And how exactly do they protect that massive lead? Well, they're sitting on a 55-year-old process chemistry IP library and a portfolio of over 450 specialty products. You just can't replicate that overnight. Plus, they've got all the crucial global certifications, Halal, Kosher, FSSC, which are basically golden tickets for the export markets. But honestly, the strongest signal for me is that the 2 founding families have their ownership locked at the absolute SEBI maximum of 75%. They haven't sold a single share. That is massive conviction.
Section 2. Financials, peak versus normal. All right, let's talk numbers, because we really have to understand why this stock corrected roughly 40% from its all-time highs. Look at FY23 right here. They posted massive revenues of over 3,000 crores, EBITDA margins of 27%, and an absolutely insane return on capital employed of 65%. But guys, that was a freak commodity supercycle. It was not the new normal. The FY25 numbers you're seeing, 2,269 crores in revenue, 22.6% margins, and a 26.4% ROCE. That is their actual sustainable baseline. The market got completely spoiled by the supercycle, but make no mistake, this normal baseline is still an incredibly strong business.
But here is the real stress-free part, 0.0. That is their debt-to-equity ratio, literally no debt. They hold an ICRA AA credit rating, meaning high financial safety, and they're just sitting on roughly 1,300 crores in accumulated cash. It's an absolute fortress balance sheet.
Section 3. The current margin squeeze. Now, despite that flawless balance sheet, we do need to address the elephant in the room. We're seeing some heavily conflicting signals right now. On one side, you have that fortress balance sheet we just talked about, but on the other, there's some real short-term pain. Free cash flow has actually turned negative. We're talking negative 472 crores. Their Piotrowski score dropped to a below-average 4 out of 9. And the big one that really spooks the market, raw material inflation dragged their core margins down to a 10-year low of 17% in Q3 of FY26.
So naturally, you have to ask, why is free cash flow negative at 472 crores? When a historical cash printing machine suddenly burns through that much capital, we need to know exactly where that money is going.
Section 4. The Mega Expansion Master Plan. And here is your answer. Management is intentionally taking a step back in cash flow to fund a massive launch pad for the next decade. They basically hit a capacity ceiling at their existing plants, so they're deploying 750 crores into a brand new SEZ plant in Navi Mumbai, which was sanctioned in H1 of FY25. They expect commercial operations to kick off by H2 of FY727, effectively doubling their capacity. But they're not stopping there. They're following this up with a monumental expansion into the United States, targeting operations by FY29 or FY30. Oh, and keep a close eye on May 2026. Those Q4 results are going to be a critical checkpoint for margins while we wait on these new plants.
Let's talk a bit more about that US plant, because it's a total masterstroke. The US makes up 26% of the global specialty additives market. Right now, exporting from India is really tough. You've got ocean freight delays and extremely strict local manufacturing date norms. But by picking up nearly 160 acres in South Carolina, Fine Organics completely bypasses those hurdles. Local manufacturing basically unlocks the massive American market in a way that exporting just can't match.
Section 5. Valuation and Scenarios.
So how do we price all this in? The stock is trading at a PE of 34.6. If we look at the bear case, say margins stay compressed and the SEZ plant gets heavily delayed, we might see a target of around 2,530 rupees. Our base case, assuming a normal margin recovery and decent execution, sits at 3,750, which is just a bit below current levels. But the bull case? If they successfully execute both the SEZ and US plants and drive double-digit growth, we're looking at a target of 6,650 rupees. The potential upside over the next 3 to 4 years is absolutely massive if they pull this off.
Section 6. Verdict and Key Monitorables. Here is what you need to track. First, watch the May 19th Q4 results. We really need to see if they can recover that EBITDA margin back above that 17% trough. Second, keep an eye on raw material inventory days. If they persistently push past 120, that's a red flag for working capital strain. Third, track that SEZ construction to make sure it hits the H2 FY27 completion target. And finally, watch out for exact CapEx announcements for the US plant so we know exactly what they're committing overseas.
All right, the final verdict. I'm giving this a stress-free score of 70 out of 100, so a solid grade B+. At the current price of 4,423 rupees, this is an accumulate. The ideal entry range is between 4,000 and 4,600 rupees, and if it dips below 3,800, that is where you want to add aggressively. It's a setup perfectly suited for patient investors who are willing to wait out the current capacity constraints until the new plants turbocharge the next decade of growth.
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.